Thank you. So again, my name is Sandy Beheimer, and I am the internal wholesaler for Columbus Life for the Midwest region as well as the Northwest region. So if we have any of the California folks on here, that is one of my regions as well. So I understand that last week, Andy kind of took you through the IUL 101. And today we're going to kind of progress a little bit ahead on some advanced case planning using the IUL. And then I'm going to do a live illustration demonstration to kind of show you what that looks like when you're trying to do the inputs. So welcome. And the presentation I'm going to use today is our life insurance and retirement planning, or what you'll often hear us refer to as a LIRP. LIRP is an acronym that actually stands for Life Insurance Retirement Planning. Some people believe that it is a specific policy, but in fact, it's actually referring to how you structure the policy. So it doesn't necessarily have to be an IUL or our IUL. Many products can be used for this, but in the instance today, we are going to use the Columbus Life Indexed Universal Life product. The simplest way to think of a LIRP as a policy design is in this particular case, in this design, we're going to reduce the face amount as much as possible, while at the same time putting as much premium into the policy as possible. So let me get through get my buttons clicking here. There we go. So again, it is a policy structure. It's not the actual product, it's the case design. And we're going to try to maximize it so that you have more cash accumulation versus more death benefit. We'll go into further detail later in the presentation as to how to properly structure the policy. But for now, just know that generally what we're going to do is reduce the face amount to the minimum non-MEC limits based on the client's planned premium. By doing this, we should be able to structure the policy with lower expenses over the long run. Now, keep in mind, and some of you have spoken to about this, when you minimize a death benefit based on an input premium, one of the limitations that you have is that you can't increase that premium at any time in the future. So that's kind of something that if you have a client who actually wants to increase the premium or layer the premium with increases as time goes on, we have to work that into the structure or the creation of the original illustration so that the policy will accommodate that additional premium going in at later dates. Any discussion of a LIRP does require a discussion about retirement assets in general. So with assets that can be considered for retirement and savings, typical assets that are included would be ones we always think of, the qualified assets, your IRA, your 401k, Roth IRAs, and several other options. In addition, you also would think of using your retirement or securities or brokerage accounts as part of your retirement plan. Annuities are very common. And then, of course, many of us are dependent on Social Security, and some of us are fortunate enough to still be blessed with a pension. So although the pensions are becoming a less likely retirement plan for your clients, you still will run into that on the occasion. But life insurance is also a retirement vehicle that oftentimes is forgotten about. And as we're going to talk about over the course of this presentation, life insurance is a diverse vehicle that can provide many benefits aside from a death benefit for your client and their heirs. And when structured properly, can be used to provide supplemental income during retirement. While talking about retirement assets, it's important to also understand the phases of retirement planning. Specifically, there are three phases, and they apply to retirement plans, regardless of which asset class you're using to fund the client's retirement. The first step is the contribution phase, meaning that an individual must contribute funds to the plan in order to get it started. If a client never contributes anything, the rest of the process is a moot point. The second phase is the growth phase, where if everything goes according to plan, the investment will work in the favor of your client. Obviously, an important part of the growth phase is to leave the investment alone and not take any premature withdrawals out of the investment. And then lastly, is the distribution phase. This is where the money has continued to grow. Hopefully the client has been disciplined and left the investment alone, and now it's time to use the money to fund the client's retirement. I know seems very simple, but it's important to keep these concepts in mind as we talk about the LERP concept. Let's use some of these simple figures to help illustrate my point. Let's go ahead and assume that this $5 represents our contribution to our retirement plan. It doesn't matter what the actual investment is. This is just an illustration. From here, we'll move into the growth phase. And as you can see, our $5 has grown to $10. Finally, we reach the distribution phase. And you can see that now we have $20 available for distribution to fund our retirement. Again, very simple and straightforward. But I think where things get interesting is when you're discussing the income taxations on your retirement planning. So let's assume you were walking a client through this three-step process and ask them a simple question. If offered the choice, which one of these numbers would you like to pay taxes on? Most people automatically would say the $5 contribution. Well, why? Well, regardless of the tax bracket, it represents the lowest dollar figure and therefore would represent the lowest tax liability. However, in reality, many people aren't paying taxes on the $5 contribution. Actually, they're paying taxes on the $20 distribution, because that's how many employer-sponsored plans, sponsored defined contribution plans work. For example, think of the typical 401k plan. Employees are able to contribute the money on a pre-tax basis. It grows tax deferred, and then income taxes are due when the funds are distributed. And of course, you're hoping you have growth in the distribution, so therefore you're going to pay taxes on the growth portion of the money or the distribution phase versus what you actually contributed on day one. In reality, some clients are avoiding paying the tax liability on the lowest amount while paying taxes on the highest distribution amount. Some clients have never thought of retirement planning with this tax perspective in mind, and it could be kind of eye-opening for them. So think about this as we talk about what will happen with your 401k. If this is a 401k, your taxable portion is the $20 because you've never paid taxes on it. The same thing with many of our other retirement type of plans, whereas life insurance is going to be treated differently, and that's what we're going to focus on today. What we're seeking to do is to switch a portion of the client's retirement assets so that they may be able to take the distributions without the income taxes. This is only possible because of the special tax treatment that's granted to life insurance. So I want to make sure you understand, I'm not saying that clients should not take advantage of their employer-sponsored plans. They should, but what we're going to do is allow the client to actually take advantage of all of the options available to them during retirement planning. When I'm stating that alert may be an appropriate allocation for a portion of your client's assets, that's just giving them some options at time of distribution so that they have both their tax deferred monies and their tax-free monies available, which will help to reduce their tax liability during retirement years. I want to go one step further and take a look at the assets from a tax perspective. And I think that you'll find when you look at these four quadrants that this particular slide, in my opinion, is very helpful when you're talking to your clients. Through the process, we're going to do something similar. However, instead, we're going to take a look at how a client allocates, how a client is allocated from an asset allocation mix. We're going to look at how they're allocated instead from a tax perspective. So normally when you're talking to a client, you're asking them, what is your risk tolerance? How do you like your retirement assets allocated? Some people are more aggressive, some people are more conservative, and they choose their allocations based on those particular prefaces or prerequisites, as well as their age, time to retirement, etc. In this case, we're actually going to look at it from how these are going to be taxed during retirement. So there are 4 tax categories, which most of you should be very familiar with. Then the first one, we're going to talk about the taxable assets. So these are the normal ones that you would expect: your stocks, your bonds, mutual funds, all non-qualified, CDs, your cash. This would be your bank account, although not much interest is being earned on any cash or CDs right now. And then the next option, or the next quadrant, is your tax deferred money. Again, we've kind of touched on this. Includes your 401k, your 403b, IRAs, annuities, and potentially pensions if you're going to draw any income off of a pension. So keep in mind that on the taxable portion, you're automatically getting a 1099 annually. And on a tax deferred portion, you're not going to get a 1099 until the gain or until the distributions are taken. The third quadrant is the tax exempt. Here we're referring exclusively to municipal bonds. If structured correctly, an individual will not pay income taxes on municipal bond interest. However, it's still reportable income. This means that any interest earned from municipal bonds is still reported, meaning that it could change the taxation of other sources of income. Also, if a municipal bond isn't held until maturity, it could also be subject to capital gains taxes when the bond is sold. Our last category is going to be your tax-free category. When it comes to tax-free assets, the most prominent one, and also very limited, is the Roth IRA. Other asset classes that come to mind are 529 plans for college funding. Assuming they're used properly, they are tax-free asset class that one may surprise. The other tax-free asset class that surprises most people is life insurance. This is a perfect time to either remind your clients or educate them on the tax efficiency of life insurance, which we discussed earlier in the presentation. Tax-deferred accumulation, tax-free death benefit, and potentially tax-free distributions. Now, if we look at how these assets are positioned, again, from a tax perspective, some individuals' assets are going to be allocated like the following. The largest holding in most cases will be the tax-deferred asset class because of retirement savings. Normally, it will be followed by taxable assets because of cash and non-qualified savings or securities that a client might hold. Oftentimes, a client may have nothing in the tax-exempt or tax-free categories, which are typically the smallest categories. So think of these items or these buckets in proportion to where the assets may be held by your client. Again, not every client will look like this, but in general, the tax deferred bracket is going to be the larger of the client's asset base. At this point, if a client scenario does look something like this, we can create new tax efficiencies. And this is where the LERP design in a life insurance policy might be beneficial to your client. So how do we do it? By repositioning some of their assets to a new asset class known as life insurance. In this case, we're using a LERP. Remember, this is a design of a product, not an actual life insurance policy. By doing so, we rebalance the client's tax position to create more tax-free assets because life insurance will potentially afford the client the following benefits: tax-free death benefit, tax-deferred cash growth, tax-free cash value accumulations, assuming it's a non-MEC policy, and potential for tax-free chronic illness and terminal illness protection. So you notice here what we've done is we've taken this portion in the tax-free region and increased it so that it is more balanced with the client's other assets. We're not overfilling this. We're not saying this is the only thing they should have, but we're trying to balance those options available to your client. So next, we're going to talk about the actual design. So we've talked about why a client would do that, why they would want to use life insurance as a supplement to the retirement. And now we're going to talk about how the actual policy works and the policy design itself. So how do you structure a LERP contract? the old way of thinking with life insurance was to get the most death benefit available for the least cost. Due to the increased cost of insurance, reflected here by the green arrow, cash values were naturally depressed. This is not a bad approach, it's just one way of doing things. On the other hand, if we can control the cost of the insurance and minimize those expenses, what will happen to our cash value? So notice here, this has historically been the goal of the policy. The client wanted the most death benefit that they could get for the least amount of premium. When we look at the LIRP concept, by designing it with a minimum death benefit, we reduce the cost of the insurance or the internal charges. This allows the cash to grow more easily without the high cost of insurance. There are several additional design points that we can discuss in more detail later in this presentation. So as I look through this particular slide here, you notice one of the things we're doing here is we're lowering the death benefit, minimizing it in order to increase the cash value. And by doing this, we've kept the policy expenses down and the client has had more access to cash as the contract is growing in later years, because they start at some point to self-insure, which is reducing the net amount at risk, thus reducing the policy expenses and the cost of insurance. One thing that you do want to keep in mind, though, that if you're using the LIRP concept and taking cash out of the contract via policy loans, the policy has to remain in force and you have to protect against any accidental lapse. So as the policy is aging and the client is taking distributions, it's important that they understand that the policy must remain in force to retain those tax benefits. In the event that the policy were to lapse somewhere in later years when there's outstanding policy loans and loan interest that's accruing, that could be a substantial tax impact to the client should the policy accidentally lapse. So keep that in mind. Policy always has to stay in force when you're using this structure. What we're discussing today is a classic LIRP policy. There are some that can be designed in different ways to maximize different cash value, but this is just going to be a traditional plan or traditional LIRP that we would do on our basic concept, or if you call in for a basic illustration. We're going to run the policy at the minimum face amount. We're going to fund the policy with the highest allowable non-MEC premium, which is usually your guideline premium limit if you want level premiums. We're going to start the policy with an increasing death benefit, or in our case, option 2, and then turn that off or switch it to option 1 when the premiums stop. Loans can start anytime after the premium payments cease and continue as long as the client is wanting to show distributions. So who's your target market for this particular concept? In general, it's not appropriate for everyone. It's a strategy that's going to help clients who have maxed out their other sources of retirement funding. And it also is the client must have enough time to adequately fund the policy before they start taking distributions. So these clients are typically going to be your high income earners or business owners, those folks who are most concerned about market volatility and have income tax concerns. So this is not necessarily best case scenario for your client who has no other retirement planning, are on a very limited budget, and are more likely to access the funds as the cash grows. That would not be your target market. Your target market is typically going to be your more affluent client. As far as the pros and cons, or the advantages or disadvantages of using life insurance as supplemental retirement, the advantages are the obvious: the death benefit, tax deferred growth and tax advantaged withdrawals and or loans, the flexibility of the UL chassis in general, just the fact that you can go from option 2 to option 1, you can increase and decrease face amounts, might be subject to underwriting. You have the living benefits. So the client might purchase this at 45, years old with a plan of needing the death benefit. They still have debt, they still have children at home, but it's flexible in the sense that then they can turn the same product into a policy that's providing supplemental retirement income when they no longer have a specific need for life insurance. What are the disadvantages? Certainly having to be insurable is one of the disadvantages. Requiring patience and long-term view. This is not suitable for immediate liquidity or even intermediate liquidity. Your client needs to have at least a 10 to 15-year timeline before they're going to access these funds. So if they're already, 60, 65 years old and they're going to need access to this money, in the next 5 or 10 years, it may not be the appropriate product to use. So, but oftentimes what we find is the client will actually allow you that 10 or 15 years for this contract to grow using their other retirement resources during that time frame so that this is working, so that this can work to its best ability for the client. And it is life insurance. And so it does have expenses involved in it that would not be involved in any other type of retirement plan. So we're going to do a case study here. I'm going to walk through it and then I'll jump in and do an illustration for you. So let's talk about this hypothetical client. We have a 45-year-old female with reasonable health. She's taking advantage of her retirement plans through her employer. She maxes out her regular IRA contribution annually, and she's looking for alternatives to brokerage account for savings and investments. She's a high income earner, so she's concerned with income tax exposure. She wants to basically retain her lifestyle as she goes into retirement without having to increase her tax liability, which would come with being solely dependent on an IRA account. So the first example was we're going to see how we can design this for a supplemental retirement income. Again, it's a supplement and should not replace her other retirement funding. We'll put an IUL in force with a traditional LIRP design, as we discussed earlier, and the plan is to fund this for 20 years, making a $400 a month payment, then beginning distributions at age 66 and taking the distributions for 20 years. So this is a pretty typical design that a client would fund the contract to 65 or 70 and then take distributions for the next 20 years or so. In this particular scenario, again, we're looking at the client contributing 20 years. We're showing an illustrated rate on this. The illustrated rate right now is 6.45. So that's the rate that I'll illustrate it at. So it's going to change the face amount a little bit from the numbers that you're seeing here. But when I do the illustration, we're basically doing the same thing we've just been talking about. We're going to minimize the death benefit to maximize the cash flow. So before I run the illustration, just so that you kind of know what the benefits are going to be, the client's going to get immediate life insurance protection. They immediately have tax deferred growth. So the money that is going in here is not generated at 1099 annually, whereas if this money would have been going into a mutual fund or a savings account or a CD, they would be getting those 1099s annually. She also immediately has potential tax-free distributions and potential income stream in retirement, and of course the living benefits on the contract. So I'm not going to jump to the other scenario here. I'm actually going to close out of the PowerPoint and jump into the software. So I'm going to stop new share. Can everyone see my screen now? It should be the Columbus Life website. Anybody jump in and tell me yes? All right, I'm going to proceed if you can see it. So if you can't, please interrupt me. Let's see a chat. Let's see what that says. All right, thank you. Thank you, Peter. All right, so I'm going to create this LERP illustration for Sue, our 45-year-old female, and I'm going to show you how to maximize this one. So let's do this, Sue. We'll use Minnesota. Going to use the IUL. So this is, if you're calling in, first of all, so that you know, if you call in and need assistance with an illustration, we can actually log in and see your illustration. So if you get in here and create it and things just aren't working out the way that you thought you remembered it or that you intended, you can simply call the sales desk and we can log in and get into your software and kind of guide you through the process. So this tab, if you notice over here on the left-hand side, we have 5 tabs. This is our policy detail tab. So this is where we're doing all of our inputs. So we're going to leave this here. We're going to leave Sue at a standard non-tobacco rating. And then we're going to move down here. For a cash flow illustration, we have this thing I call the magic button right in the middle of the page. And if you click on the max cash flow button, it actually changes our type of illustration to solve for cash flow. That means you want to see distributions. So I'll show you after we finish this one how to run one without the distributions. So what this did was minimize our death benefit, our face amount automatically. You do have other options, so you can change it to input. The only time I would change it to MEC limit would be if you're going to make it a less 7 pay or less. I wouldn't use that in most scenarios, because if you do, it actually tries to fund the policy in the first 7 years and you run into all kinds of numbers issues. The premiums aren't level. So typically you're going to run this with a minimum face amount. Notice it grays this out here. Remember, if you're from the PowerPoint, it says that we're going to do the increasing death benefit while we're paying premiums. In order to make the change from option 2 to option 1, you go into the little bar graph there that looks, well, it looks like a bar graph, a little icon. And here we're going to let her pay premiums to 65. So I simply change that to 65 and it automatically defaults it back to option 1 level to age 120. So I have 20 years of option 2 while I'm funding the policy, and then the balance of the years will be level. Remember, that is to keep the policy expenses down in later years. I know some folks have the concept that the client dies, they want to get their cash value plus the death benefit. But if you carry that into a client's later years or as they age, the policy expenses on that face amount becomes so expensive that it actually is really hindering your cash accumulation. So typically you're going to want to try to dial that back down so that you are basically starting to self-insure until you take your cash out. So here we're going to use the $400 a month premium that was mentioned in the PowerPoint. We're going to pay that to 65. We're going to change our mode to monthly, which is our pre-authorized transaction, PAT. We're going to leave this at guideline testing or guideline premium testing. The reason for that is for this particular product, we have what is called overloan protection that prevents the policy from lapsing in later years after age 75 in the event that the client is taking distributions or loans on the contract. And it basically will just freeze the policy. No more distributions can be taken, but it would prevent a lapse, thus creating a tax liability. And so we want that overloan protection to stay on here. And in order to do that, we have to keep this at guideline premium testing. Notice when I hit the max cash flow button, it also defaulted here for me for cash flow loan 65 to 85. Now these numbers can be changed. So just for the sake of illustration, I'm going to leave it at 65 to 85. But you can, if this client wanted to pay premiums to 60 or to 70, you simply would change the to age. Now it's important to remember that this line here, premium option, premium, and to age, is how long you pay the premiums. Target age is how long we want the policy to run. So normally you're going to leave this at 120. So don't confuse the two. This is how long we pay the premiums. This is how long we want the policy to run. In this case scenario, we want to do loans the entire time instead of withdrawals. And we're going to do it for 20 years. Again, you can change this to 100 or 120. but just trying to maximize the client's access to cash, we're typically going to leave it in, in the 20-year range or 25-year range. Why do we not switch this to withdrawals first, withdrawals to cost basis and then loans? Because if you do any withdrawals on the contract and it's on level death benefit, it automatically reduces the face amount. That's reason number one. Reason number two is if you withdraw the money is no longer working for you. If you borrow against the money and you're using an index loan type or a participating loan, the money is actually still in your allocation options. So the money is still working for your client. Now you do have the ability to change to a standard loan option. And I know that's one of the things that you wanted that I was going to cover here today. So I'll kind of touch on it here. So an index loan, again, is a participating loan. That simply means that the money still continues to work for the client. The loan interest charge is higher. Currently it's 5.5 and the guarantee is 6. So if your client is paying 5.5 or 6% for loan interest and earning potentially the 6.45, then they're still ahead of the game here. On years that they potentially have a 0% return, because this is an index product, then they obviously have the charge, the additional 5.5% charge for the loan interest. But if you've taken the money out of the policy as a withdrawal, it's not making any money. The other option is a standard loan. A standard loan is going to be typically a wash loan by the 10th year. So basically it's a 2% interest charge or 2.5% interest charge. And the guarantee on this contract for the fixed interest rate is 2%. So right now we're paying 4.2 in our fixed account, but the product guarantee is 2%. So in the event that the contract was paying 2% and charging 2.5%, the net cost would be 0.5 basis point in the first 10 years. And then the 11th year, when the persistency bonus would pay out, then it would be a wash loan if you use a standard loan. But for the most part, you're going to illustrate larger distributions if you stick with an index loan. And you can switch the loans back and forth. They have to be at least 1 year between loan switching, but you do have the ability to switch back and forth between a participating loan or an index loan and a standard loan. So I know that's kind of brief. We do have some additional training in reference to this, but in general, it's going to default to the index loan. And most, I'm going to say 99% of the producers that are illustrating this concept are illustrating with an index loan. The next step down here are defaults as well. The solve criteria is maximum assumed interest to keep the policy in force to age 120. Normally, you're not going to want to do this to change anything here. And then you do have the potential to decrease the face amount on these products. So oftentimes you may have seen, some of you that might be a little more advanced in this concept have decreased the face amount when you went from option 2 to option 1 and when you turned off the premiums. That's certainly an option. It's not something that we automatically share here. I mean, we don't automatically do that. And the reason that my personal thoughts on that is that in the event that this client gets to this point and they're ready to do their distributions and they've not averaged 6.45% perhaps, so now their income stream is going to look a little lower than what they anticipated. This kind of gives you as the producer an extra edge on it so that you can potentially decrease the face amount to bump up those distributions should you need to do that due to lack of performance on the contract. That's just kind of a little side note. Certainly with this, you can still do a lump sum contribution to the contract as long as it doesn't make the policy a MEC. And then we'd also would accept a 1035 exchange, and that's where you would put that in. And I'm going to skip over the premium deposit account today, but if you should have questions about how to use that, certainly give me a call at the sales desk. So we basically have set this contract up just like the PowerPoint. Minimum face amount, option 2 to option 1, premiums to 65, loans 65 to 85. So what does that look like? We're going to jump here to the values tab to give you a picture of what you just created. So because this is option 2, this is the actual death benefit. The start base death benefit is going to be slightly lower here, but we're somewhere in the $150,000 range. And if I scroll down, what I'm looking for here is I just want to make sure that the policy stays enforced to 120, and then I have some type of distributions, and I do. So I pay in $4,800 a year for 20 years. I have life insurance during that 20 years. I get 14.7 ballpark out for 20 years. Life insurance is still in force. There's at least a minimum death benefit there, and the policy remains in force to age 120. Of course, this is all non-guaranteed and all based on an illustrated rate of 6.45. And I am using the 0% floor in this case and 100% capped on the allocation. So now I want to show you the report selection. I'm going to add a couple reports because that's helpful for this particular scenario. So I'm going to add Understanding Your Life Plus Rider. I'm going to add a Simplified Ledger that illustrates the loan that we created, and the lifetime benefit report. And then I'm going to the action and preview illustration, and we're going to look at the PDF here. It's a little bigger. So the first page, just so that you see where we're starting at here, it's actually page 2. You can see here on the left-hand side, it tells you where we started, female 45 standard. The actual death benefit where we're starting at is $153,803 based on that minimum death benefit. Option 2, $400 a month. So if you scroll down here, in the event that you had 1035 or lump sum monies, they would show up in here. And then you see this number down here, minimum monthly premium for base guarantee, $81. We always get questions on that. That's the premium that's needed just to put the life insurance in force for 10 years. So that's really an irrelevant number on this particular illustration, but I can promise you that your clients will ask about it. Why do I have to pay $400 if I could put in 81? We're going to jump down to the ledger, just so we can kind of see how the policy is growing. So you notice on our ledgers, we have the 0% guaranteed max cost of insurance columns, midpoint, and then the 6.45. That's our max illustrated rate right now. So if I look at this down when the client turns 65, she's paid in $96,000. At age 65, she potentially has $308,000 in death benefit and $154,000 in cash value that's accessible to her for an income stream, assuming the 6.45 illustrated rate. She's immediately starting income. We're using an index loan so that the money continues to work for her. And as she's aging, or as she's pulling the money out of the contract, the death benefit's obviously going down because we have this loan that is growing against the contract. So here, basically, we know that we put in $96,000. She's taken out $294,000, and she still has some amount of insurance in force at the same time. In addition, she's had her living benefits. So we'll scroll to that ledger next. So here it shows the living benefits. So the chronic illness, periodic payment and lump sum, specified medical, and terminal illness. So basically, I'm not going to get into how this is calculated today, but in the event that she should need to file a claim when she's already started taking distributions, we would calculate what her claim benefit would be. In this case, let's just say, and let me jump down here. We'll say at 75, her claim benefit is $289,000 because she has chronic illness and she's met the qualifications. If she has an outstanding loan at that point in time of, let's say, $100,000, we would pay that loan off and she would get the difference for her living benefit claim, just so that you know how that works. You don't get to double dip, but it does allow you to take the claim, pay off the loan, and then maximize the claim benefit. The next page on this illustration I want to show you is the one that I said was a simplified ledger. I like this because what it does is it shows the premium dollars going in, and then it shows your loan growing. So What you can't see on the other ledger is how this $14,000 a year is growing in the form of a loan. So remember, we just said that in this instance, if she had a claim at age 75 and she could qualify for like 289,000, we would deduct whatever her outstanding loan was from that claim amount. So this is where you can see what that potential loan amount is, as and how it's growing. So if she only paid in, the other issue that I mentioned was if she only paid in 96,000 and she gets down here at this point at 75 and decides, I'm just going to surrender this policy and walk away with this $90,000 cash. Well, if she does, she has a tax liability because she has a $194,000 loan and her cost basis is only $96,000. So that's why it's important that you explain to the client when they're going to use this as a retirement supplement, that the policy has to stay in force. So that's why I like that particular ledger. And then the other thing that I mentioned to you earlier, I'm going to jump back up here to my premium limits. One more page here. And this will always be on the last page before the living benefits. I referenced Guideline annual premium. This is a very important number. So when you're dealing with life insurance and trying to max fund a contract, the most money that you can put into a policy annually is going to be this Guideline annual premium. And even though you can violate MEC and make a contract on MEC and put in more money in the first 7 years, and the contract would let you put in this $5,400 until you met this $24,700 number, it would let you put the higher number in. But when you hit Guideline premium limit, there is no working around it. It is zero. No additional money can go into the contract when you hit these limits. So that's why I said when you minimize a face amount, you need to make sure that you realize that you can't put any additional premium in. So in this scenario, we showed the client putting in $400 a month. And so 10 years into it, if she calls back and says, hey, I can increase this to $500 a month, can I do that now? The answer is no, without going through underwriting. So it's important that when you're choosing this face amount for your client, that you give them room for that. So you can do a couple of things. You can either bump up the face amount if you're confident they're going to add additional premiums later, or you can layer the premiums. So basically what you would do here is go in here, layer the premiums. Let's say she's going to do $400 a month for the first 5 years. And for the next 15, she wants to do $500 a month until 65. So that then would accommodate the death benefit. And it's going to bump up your Guideline premium because you input that requested additional premium. So it's going to bump up your face amount and it's going to bump up your Guideline limit. So instead of $4,800 a year now, because I showed that increased premium in later years, it will allow her to put that $500 in. So it bumped it to $5,700. Now, keep in mind that your commissions are your commissions are based on your plan premium and our target premium. Are actually based on your target premium is based on the face amount of the policy. So when we're minimizing the face amount of a policy, that's what your target premium is based on, is what the face amount is, not how much money you put into the contract. You get paid on overfunding the contract, but the higher commissions are actually calculated, or the target premium is calculated based on the face amount of the policy. I also mentioned that I would explain to you, what if they don't want to show cash flow? What if you just want to show the client this product growing for cash accumulation and not show distributions? So the way that you would do that is change this to input all parameters. And we're still going to leave everything else the same. We're going to leave the minimum face amount. We're going to leave option 2 to option 1. We're going to leave the premiums here to 65. Remember, I layered the premiums on this, so I changed it. That's why it shows 50 here. We're really paying them to 65. And what that does, instead of showing distributions, it just shows the cash growing. So what that does there, it shows you turning off the premiums and it shows you leveling out the death benefit, but it doesn't show any distributions. And so if the client wants to use this kind of as a nest egg or an emergency fund and not necessarily plan on taking distributions out of it, this is the way that you would format that illustration. So what questions do you have now? We only have like 7 folks on. So by all means, feel free to either type it in the chat or just ask me your questions. Or case, if there's something I haven't covered that you would like me to cover now, let me know.
Okay, guys. Do any of you have any questions for Sandy?
You guys are making up. Somebody's putting something in chat. Let's see what that says. Looks pretty simple. It can be once you run a couple of illustrations. And I'll be honest with you, this is our flagship product, and probably more than 50% of our sales are formatted in this is a LERP concept in general. Everything from your client, like this particular client, putting in $400 a month to supplement a retirement, to, you know, younger clients that are high income earners, they're putting in, you know, 20 or 30,000 a year. Did I miss anything that you wanted covered in reference to this concept today?
Looks good to me. See if you guys have any other questions for Sandy.
Somebody said, are LERPs for whole life insurance? So certainly they are. We don't actually, Columbus Life doesn't offer a whole life product. Our sister company, Lafayette, does. And they do use the same concept for their whole life products, typically pretty high face amounts, I believe. I'm not sure how they structure the particular product, but I'm guessing it would be rather similar to this. Somebody said, can we run a quick single premium? We can. Let me jump back into this one. With a single premium scenario, a couple of things are going to happen here. It's automatically going to become a MEC if we don't use the premium deposit account. So, and we're going to run it with a level death benefit. So for example, here, if we did 20,000 1 year for this 45-year-old, change it back to annual. And typically what it's going to do, the biggest issue is it might not give us the long-term, the longevity that we would get out of paying an annual or monthly premium. So in that scenario, I dropped in, oh, I got to take out the rest of the premiums I put in. So I'll show you 2 situations here. I'm going to show you making it a MEC. And honestly, a MEC would typically not be used for a LERP concept. It's going to be used more for an estate planning tool, meaning because with a MEC, you're going to have to pay the taxes on it when the distributions start. But you can see here that basically your $20,000 single pay purchased $123,000 and it grows. Could they take income off of it? Yes. So if I do the same thing here and I minimize the death benefit and I start trying to take an income stream on it, let's see what it looks like. It's minimal, but that $20,000 does produce an income stream and does maintain at least a minimum death benefit. Obviously, if that payment was higher, it's just going to force all of the numbers up. So the concept does work using a single pay, but keep in mind as the money starts to come out with a MEC, it's last in, first out. So there would be a taxable portion of all of this, of these distributions. The other way to use the premium deposit or to use the, gonna throw me, let's see. The other way to do a single pay is not a true single pay. It would be use the premium deposit account. And in that case, you're basically just putting the money into our PDA, which acts like a money market account. To check that. And that cannot be a MEC. So I would just check here. I'm going to add, we'll leave it at $50,000. We're going to let the money go into the contract. I like to do 6 or 7 years is the kind of what I call the sweet spot when using the PDA. There's no magic way to know which looks best. 4 years is usually too short and 10 years is usually too long. And those are the ranges to use the premium deposit account. You get paid on the premium dollars as they enter the life insurance contract. You don't get paid on the money that's put into the premium deposit account. The client does get a 1099 on the interest earned in this account. Currently it's paying 2% and the guarantee is a 0.5 basis point. So if I do that and I made this into a 7-pay, same concept, we're still looking for distributions. Oh, let me go back. I would change that back to option 2 to reduce the death benefit. So because we're doing more than just a few years, I'm going to use the option 2. In this case, I'm only going to do to 52 because I'm doing this as a 7-pay using the PDA. So after they put the money in, even though the premium dollars are only going into 52, it's sitting, working, growing from 52 to 65. And again, we basically are putting premiums in for 7 years. We then level out the death benefit and start distributions. So same concept, just a different way of funding it. So we're still using the LERP concept. We're just funding the contract differently. So whether you're paying monthly premiums for 20 years, or you have a client that just wants to do a single pay, a 5-pay, a 7-pay, a 10-pay, you can do all of those things with this product or with this concept, and definitely with this product. So what you keep in mind here when you're doing the option 2 to option 1, you really only want to use option 2 if it's probably 5 years or more, and if the client's under age 60. As the client starts to age, you're going to find that you lose the benefit of the option 2 to option 1. Client wants to transfer 100,000 401k. How will we demonstrate the best case scenario? Is it better to do a lump sum or 1035? So 401k monies are qualified. 1035 monies are non-qualified. So you can't directly move qualified assets into a retirement account. It would actually have to be distributed before it can go into the retirement, into the life insurance, I'm sorry. So the 401k can't be directly funding a life insurance contract. So first of all, for us, we would use a SPIA, an immediate annuity, instead of the premium deposit account if the money was from a 401k. And we would set the SPIA up similar to what we did with the premium deposit account. And then the SPIA would fund the life insurance policy. So if you had $100,000, you create the SPIA and you get paid on the annuity contract. And then you simply figure out what I call the sweet spot again, 5, 6, 7 years to fund the life insurance contract with the SPIA. And you basically have done just what I did with the PDA. Client does have to be 59.5 though, for us to take the money in and do a SPIA to life contract. That's one of our current suitability regulations. If they're under 59.5, they would actually have to cash out of the 401k, take the tax hit on it, and then put it in just as regular cash. 1035s or lump sums are non-qualified monies. So those would not be coming from a 401k. That would be coming from some other non-qualified asset, like a savings account, a CD, sale of a security, etc. A 401k to a SPIA would be a transfer, or it would be a rollover. A 401k to any IRA is a rollover. And then moving it from an IRA to an IRA is a transfer, or a 1035 non-qualified money, like from a life insurance contract to a life insurance contract, that is a transfer. So you really have to differentiate between the qualified and non-qualified. Yeah, and just, I mean, our sales desk as a whole does not have the background in qualified versus non-qualified. We're not securities licensed currently. However, my background is such that I had my own agency and I was a registered investment advisor. So fortunately, that brings to the table that background of, understanding the concepts between the qualified and non-qualified assets and what can be moved. We're trying to push our suitability team to open this up to folks younger than 59 and a half using the SPIA to life. Simply because, we have folks that are wanting to move. When you get into $100,000 range, they definitively need to talk to a tax advisor before they would make that kind of a change, or rollover, or move because of the potential tax consequences. But for clients that have smaller amounts, you're a young person who's leaving a job and they have $20,000 or $30,000. They love this concept. And unfortunately, right now we're limited. We're not really able to use that concept for that bracket of client. Could they use refinance cash out money to fund the contract? Not without underwriting approving it. So there is such a thing as premium financing. That's on a much larger scale. Lots of pre-requirements involved in that. But in general, if you tell us that you refinanced your house to drop 100 grand in here, it's probably not going to get approved. Any other questions? Moving forward, certainly we are more than happy to schedule additional time that focuses strictly on the illustration concept. We also can do the living benefits training, etc. Or if you have questions about the loan, the standard to the index, if I didn't cover those thoroughly enough today, by all means, give me a call in the sales desk or shoot me an email. And I would be glad to cover this for you. You get in there and run these illustrations and get stuck, give us a call and we will help get you unstuck.
All right. Thank you very much, Sandy. That was great. Thank you very much for your time. And guys, next week, we will continue the IUL training module number 3. That would be, we'll be discussing and launching the new IUL software that can help you to write more index universal life policies and much bigger policies. Okay, so you don't want to miss that. So thank you very much, Sandy. And we'll see if next week you or Larry can join us again. Okay, thank you very much.
Sure. Look forward to talking to you all. Have a great day.
Thank you. Thanks.